This is our Suburb Trends report for March 2022, and we'll be looking at where prices are moving across the country, either up or down, and why they're moving, and a few surprises. In this episode, we'll be discussing the change in market conditions that was felt in many markets across the country at the end of last year, and we'll discover which areas are showing strong signs of softening and which ones are holding up. Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia, and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free full or forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au. This month we've asked Kent to look into where markets are showing signs of softening into 2022. So Kent, can you kick us off by briefly explaining how you've tackled this challenge?
Yeah, so I've grouped everything according to a statistical area 3, or SA3 as I love to call them, and I've swept across current listings, counted them up, compared them to where they were 3 months ago, compared them to where they were 3 weeks ago, and then analysed it against sales volumes. And what do you get with that? You get inventory analysis. So higher levels of inventory, we know that that's a fairly soft market. If it's building, if inventory levels are building, we know that's a weakening market. And what we've done as a result of this is I've done a bit of a forecast. I've said with interest rates likely to go up, with some global concerns and global risk. As of the time recording this, we've effectively on the brink of World War III, it appears.
It's a nervous laugh, Kent.
I know, I don't mean to laugh at it. It's a nervous laugh. And as a result, what I've done is I've said, assuming a 20% reduction in sales volumes in the coming weeks, what impact would that have on some of these SA3s? Which ones are going to be performing really, really well, and which ones are likely to be the softest markets or changing.
Right, and I just want to distinguish a couple of things around inventory and sales volumes just for our listeners. So inventory goes up when one of two things or two of two things happen. One is when more listings come onto the market, and two is when sales volumes fall. Right, so that sort of is the cause of, and if those two things happen, obviously that's a very soft market, as opposed to can just be normal sort of market ups and downs. Are you seeing both of those factors kicking in, or just one?
There's some markets we've identified where both are happening. There's some interesting scenarios where we have markets that just have so few listings coming on, and currently, that even if demand dropped off, they're still hot.
Yeah.
So, and what this underlines is, when people refer to the Melbourne market or the Victorian market or the Australian market, how wrong it is, because this is very much a patchwork quilt.
So you've got two sides of the coin. When things are going bad, more listings are coming on and less are selling, and it's just sort of this glut of listings. Buyers are like, well, I've got lots of choice. Well, there's more coming on. I'm just going to sit on my hands. You start doing lowball offers, fire sales, etc. It's just like this cycle. And it's the same on the other end, right? Very low listings, low coming on. People are desperate. People are like, well, if I don't get this one, I'm not going to get one all year, etc. So it winds up FOMO, but it also winds the other way, right? So
the other way,
the fear of not buying as well. So what's some of these areas that you think, Kent, where the spiral's heading in the wrong direction, I guess, where stocks sort of sitting on there and then also lots of stocks coming on?
Yeah, well, I'd probably prefer to call these markets the ones that are probably most vulnerable, because if sales volumes fell off just marginally, where they are in terms of pipeline supply and current listings, the standout at the moment is Perth. So, I called out Perth as, last into the party and maybe first to leave the party. So, across the Perth, inner, northeast, northwest, southeast, these are markets where it does appear that they are the most vulnerable to a very modest change downward shift in sales volumes.
I'm just looking at your thing here, Kent, though, but it's always northeast, southeast of Perth. There's not many west of Perth, right? So it's all the, east of the city, which is not like Sydney, the eastern suburbs. It's the west in Perth where the money is. So is that what you're seeing? It's all these house and land packages, investors who got caught up, and finally this is an opportunity to get your money back that you've been underwater for almost a decade. And people are like, oh, now's our chance to finally sell. And is that what you think's happening?
Yeah, it's always good to drill in and look at the listings and look at sort by latest. So when I pull up an SA3, I sort by latest, and it tells me what's in there. And what's really interesting with a lot of these house and land areas, whether it's a seasoned house and land area or a new one, is just how many houses that are in the secondary market. So they're not, and I feel sorry for a lot of those people that have owned a property maybe 4 or 5 years. They haven't really made much of a gain, and now they're competing against government grants.
Yeah. So and they're massive in Perth, from my understanding. It's over 50 grand, and maybe even more. Some of it's a home builder, plus there was a state grant, I think. Veronica, I think you know a bit more about it, but I knew that it was the largest in the country last year, or like 2020. It's
an interesting catch-22 because we need housing stock. But what the facts are that where we build a lot of these new housing stocks, it is the most vulnerable market for several years.
Yeah.
I think partly it's so vulnerable because of all those incentives making people pile in, having a false confidence and a false sense of how much, they're getting free money. They don't realise that that's actually not free money at all, and they also don't realise that the next lot of buyers won't be given the same amount of free money to buy their house. Yep. And I think that's the trap of it. So it'd be interesting to see how the markets behaved if there weren't those incentives. Potentially, that they potentially, or I think, and this is the thing, I think people would be better off if they didn't have incentives, because then there would be a proper, healthy market for those properties when they went to resell them. Yeah,
paper-based incentives just don't really change the dial. You need to, create supply.
So the standout you said was Perth, and I feel very sorry for all those people over in Perth because they have had a shocking time over the last decade, and of course, there was a very small window of opportunity with the post lockdown or post COVID or whatever you want to call it boom that we had in end of 2020 and into throughout 2021. So you're basically sort of suggesting that window of opportunity is slammed shut.
Well, it depends. If demand increases, which chances are small, but it's possible. If demand suddenly increases, then this will be less of a concern. But given the rise in listings, given their pipeline supply, there's a lot of new building approvals that have gone through in the last 18 months across most of these areas. There's a strong pipeline supply, strong and high level of listings. It's very vulnerable to a slight decrease in demand.
Well, you've also got interest rate rises on the horizon as well. So, that's... okay, so what's after Perth?
Well, I think that the summary, if I kind of go out macro here, say I've analysed 329 SA3 markets. Now, applying those assumptions in my approach here, we've gone from an average of about 3 months of inventory 3 months ago, which was, a very strong seller's market across the board. Now, that's the average. The where we would sit in the coming weeks is closer to 5 months of inventory. So that's a fairly dramatic shift, if all things equal. So now, of that, 53 out of 329 would have 6 months of inventory or higher under these assumptions. So that's 53. So what that really says is we're still in a strong, the markets are still strong. And what we're comparing everything to is just this extraordinarily low levels of inventory and price rises. So, I think we could be 6 to 12 months before we get back to anything that we would consider long-term normal. But so anyway, so where we're at. So we there's a couple of other areas that stood out here. A very, very slight weakening in Richmond Tweed. So it's going from 160 kilometres an hour, as we spoke about last time, down to maybe 110. But that was an interesting one, because I only thought that there's perpetual upside there, but it does look like Richmond Tweed might just start to be easing slightly.
So that's the Northern Rivers, right? That's your favourite part of the world, Kent, if I may say so, Byron Bay.
Yeah.
Does this include Byron, though?
Well, Richmond Tweed at an SA4 level is split into two, the coastal and then the hinterland.
Yeah.
Okay.
So I've just grouped them together and said that broader area, for the sake of it. So, that area is just starting out, but it's gone from red hot, maybe looks like it's going back to hot. So that was a
funny you say
standout.
that. We actually, I was literally, I think it was one day this week, can't remember what it was. A client was looking to buy, he's living up there, got a house in Sydney, but he's able to work remotely. Didn't know. He just said, look, I'm now living up here, I'm renting up here, we want to buy a house up here. I said, oh, okay, what do we do? Let's do the numbers, see what we can buy. And I did a quick look on, Domain Real Estate. I was like, wow, there is actually quite a lot of properties on the market in places like, your Pottsvilles and your Kingscliffs. And I remember looking just in the height of COVID in the last couple of years a few times, and I'm thinking there wasn't much on the market. So it must be that, they're seeing that the market's slowing down. It's an opportunist. They never thought their house would double and they could get 1.5 for their shack, but they can. So, and it seems like that's when you can already see that the demand's probably slowed down a little bit as well, and now there's a bit of stock sitting on the market.
Well, if you've got a holiday home, it's probably a good if you need to sell or want to sell, it's probably a good time to think about it.
Cash in, and that's right. Probably is a lot of holiday homes up there, yeah.
I think you might have had to have already thought about it and potentially have done it.
Good point.
That's the thing, isn't it? Like, are we going to say that September 2021 was when, the optimal time to sell was, because I think there's some sales that aren't getting as high as that, right? So it's very hard to time the top. It's usually before you think it's the top.
Yeah. It's interesting. I've heard quite a lot of anecdotal feedback around that area that a lot of people, in the acreage sort of space have been deciding now's the time to cash in. And so, it's that sort of those people watching the market all deciding at the same time, which is sort of weird how people tend to do that. And then, of course, that sort of precipitates a slowdown by its very by the actions of so many people. So
it's like when you start a new business, you think, I've got this amazing idea. You spend months and months in this little sandbox, not telling anyone, and then when you launch, you're like, wow, there's 3 businesses launching pretty much exactly the same at the same time. Humans are thinking the same things all over the world. So, you're not special.
It's a V. Oscar effect. I don't know if I've given this example on this podcast before, but when I used to work in restaurants a long time ago, when veal Oscars were often on the menu, there would just be nights where everyone ordered a veal Oscar. It was bizarre. It was like, but they all hang out around the corner and go, tonight I feel like a veal Oscar.
Subliminal. There's some interesting trends on the positive side, and this was a surprise. The western suburbs of Melbourne, northwest, Melbourne West, Melton, Bacchus Marsh, Tullamarine, Broadmeadows, Keilor. These are looking strong, very strong.
Really?
And I did not expect it. So they jump off the page when the data says now. Even with the assumption that sales volumes could fall back, the listings volumes are so low and inventory levels are so low that they're still looking really, really strong. So that was a surprise how strong they are. Now, probably the other call out is as the borders open up, people love Melbourne. A lot of overseas migrants who arrive and call Australia home just love Melbourne. So that's going to be interesting.
I agree. I think Melbourne's going to get its mojo back, I guess. And a lot of people, I think Melbourne's all about the city from, living down there. And when I visit, it's all about what that city offers, right? It's a bit like a global city, in Australia, we don't really have elsewhere, right? So, if you live in Melbourne and you're doing well financially, you want to live in the action, right? If you can. I think these last couple of years, we've seen clients go to the Elthams and the Dandenongs and Mornington and Geelong, etc. But I think, when that return to work comes back, that inner city Melbourne will get back. When migrants come, you're right. Sydney, Melbourne's where they come, because of work. So, and it's probably the only cities they know a lot of the time. So I agree. It's going to be interesting to see how Melbourne's comeback is over the next few years.
Yeah.
Kent, we were talking, off air, and you were saying that, and we're recording just for transparency because we won't release this till mid-March, so anything could change between now and then, but we're recording this in the very dying days of February. And you had said that literally in the last 2 weeks you've noticed a real change in some of these areas. And anecdotally, I was talking to one of my team today they were talking about the Blue Mountains, and they're saying that all of a sudden agents, price drops and agents on the phone, and it's very, very sudden. And these things do change on the ground very suddenly.
Yeah,
so
do.
what is it that you've been picking up?
Yeah, I did a quick sort of the SA3s that have had a 20% or more increase in listings in the last 3 weeks. So this is a substantial jump. Now we've got Brighton down in Melbourne, the far north, don't worry about. I'll pull out some of the ones we're all more familiar with. Adelaide City's had a bit of an increase. This is housing stock in their SA3. Canada Bay. Now you both know Canada Bay. It's in close to the city there. So Broadbeach Burleigh. Now that's an interesting one. So it's one of the tightest markets in Australia, but we've seen an increase in listings.
This is housing you're talking about?
Housing. So housing stocks across the SA3. Barwon West, I can't even remember where that one is. Leichhardt, we know where Leichhardt is.
We do.
So Leichhardt's seen an increase. And then Hobart Northwest. So maybe it could be the early signs that Hobart could be returning to normal because it's been extraordinary for years now. So that's interesting.
I do wonder if the lockdown effect in 2021 and the, not people able to move around, etc. People were like, couldn't get trades, couldn't get stylists. There was not many people could list late last year or didn't have the confidence to. Everyone thought about it over Christmas. Everyone tried to list in, January, February. And I think this is the real test of the market because you've got this real fear around what's going to come, rising interest rates. Everyone's very fearful of that. We've had, even last night, ANZ increased rates dramatically. CBA did it this week, ING for the 4th or 5th time as well. So interest rates have jumped up a lot. Obviously, the worries with, the Ukraine situation. So it's going to be a real test over the next 6 months for a lot of markets where, they potentially already had a lot of stock or a lot of stock's coming on and buyers are pulling out. And it's a real test to see if they can maintain the prices of last year, I guess.
Well, it was interesting. I was listening to President Biden address the address this morning, and he made special note of fuel prices and inflation. So it's a big issue. It's a global issue, and it'll flow onto us. We're not going to be immune from it.
So fuel prices, that might cull the tree change, sea change a little bit.
Well, you just work from home more, and you do less. You drive less.
Although I mean, in New South Wales now, it's like city's open for business again. Perrottet is very intent on saying, well, you know what, they're really what pandemic. We're also enough people have had it that everyone's saying, it's just like a cold, that we don't have to worry about actually precautions anymore, and come on, open slather, let's get back to work.
Well, it's a bit of a dampener. World War III dampens the COVID reopening party a bit. Hobart appeared in the south and west as well, and Devonport. So it's interesting. Some of these markets that we, may be just starting to come to the end of their party.
Well, they've been
investors
closed
as well in Hobart, right? They could be. The investors have got in there. They've seen massive price increases. Maybe we should take our money and run, because it is one of those markets where you probably don't want to sit in for 30 or 40 years potentially, especially at current prices. So do you reckon that, is there any way to know that a lot of listings are coming from, people who have rented their properties?
Well, yeah. Look, what I did a bit of an analysis for an AFR story last week, and I was looking at the properties that were ex-rentals that came on, and the variable of interest there, well, the story or the topic was to look at, is the rental pool going to shrink as a result of this? Now, ultimately, what matters is the stuff that's selling and how many of there are, how many of them flow back in as rentals is your big thing, because rarely do you see a number of properties list above the rental tenure percentage. So if you say the national average, say 35% rentals, there's really no suburbs I can find, or SA3s I can find, that ever have more than 35%, or the average rental tenure listed for sale as ex-rentals. Wow. So with that in mind, what you do look at is those suburbs that have all the other rental factors looking bad, as in there's just no available rentals, there's low rental tenure, price going up, and you're still seeing some ex-rentals hit the market. Your biggest concern is how many new rentals are adding in, how many investors are going to come in and top it up. That's the biggest variable of interest.
As prices rise, they become less desirable to investors because they're more expensive, and investors go, like cheap and cheerful. We agree on this podcast. And it's as natural what happens. A market could be quite balanced between investors and home buyers because it's at a price point where both would consider it. But as the price gets more expensive, investors less can afford it. You think about housing in Sydney at $2 million. Like, what investor is going to go and buy that? Very few.
0.5% yield. I mean, but it's a market that conflicts with that logic at the moment is the mid-north coast of New South Wales. Critically low vacancy rates, really good yields, very, very low pipeline building supply. So it's a crisis for the renters. The community housing groups, etc., are in all sorts of strife because homelessness building up there.
Oh, yeah.
And you've got really low socioeconomic. So these poor buggers are really under the hammer, and the investors aren't really buying there at enough. So there's just not enough pipeline supply, not enough investors. If there's any part of the world that needs help right now, it's there.
Yeah, homelessness is real. I've seen a situation, close to home where, family or family, can't moving out of one rental and can't rent another place. Keeps getting knocked back, and it's just too much competition, and their situation doesn't look great on paper, and it's impossible. And the days are ticking down, and so, it's going to be a place where they have to live with someone else, right? It's a real problem out there that there are real lives out here. And these listings are real lives as well. Like, we would talk about this at a macro level. When you see lots of listings, and these are people's stories, it's their experience, it's the stress and the years of this thing playing out, and on top of their mind, why did we do that? If we didn't do that, we could have been here, and how do we get out of this? And so that's why we care so much about this, because there's a real lives behind these stories.
Yeah.
Yes. So now I think you want to...
Just on that one, because a lot of the issues in sort of the regional areas that are popular amongst holiday goers is not only are these, rental properties taken out of the market and then sold to owner occupiers, but they might be sold as holiday homes, but they're also been putting on Airbnb. There's the short-term rental market as opposed to the long-term rental market. I know I just hit you with this because we haven't actually discussed it, but is there any indication as to how that's playing into this and what sort of extent?
I haven't really covered it enough to talk about. So, I think with the rental market specifically, it's what I'm finding with the rental market. Probably the standout metric there at the moment is a lot of the high vacancy rate areas starting to look better. Yeah. They're improving.
Yeah.
So I think that'll have a flow-on effect to everything. So these pockets of high vacancy rates, such as your Docklands, such as your Melbourne, etc., are all looking better. So I think the heartache of a lot of the inner city high-density investors will start to ease a little bit now.
Well, I'm presuming that's because the borders are open again, and we're looking at overseas students and immigration. So, and typically a lot of those people would go to those type of properties, right?
Oh, well, I think that you'll flow to where the properties are available. You don't have you don't have schools to worry about. You don't have a job yet, so you'll just go to where, and you there's some pretty nice apartments available in Docklands for a few $100 a week. So why wouldn't you?
It's a good point though, Kent. If you can't go rent a property in an area that you really want to be, you'll have to go where there's properties available. And, if you can't rent that, maybe it's for socio-economic reasons or something, you have to go to an area where maybe it's a bit cheaper and and it's easy to rent. And this is where you get a different type of demographic shifting into these areas. And that's sort of what happens, right? And more and more housing stock come on. So we've got to be very careful that, these suburbs don't become areas where the socioeconomic starts to deteriorate and you get this more supply and then it's less desirable, and then if it's less desirable, then all of a sudden you've got this pocket where people don't want to live, but there's lots of housing, for example.
Well, it's interesting that I find the CIFA index, which I love, that 1 to 10 index that says, 10 being the most socially advantaged.
Yeah.
When you look at things such as the leading indicators, such as vacancy rates or inventory, so vacancy rates versus rent price movement, or inventory versus house price movement or sale price movement, the CIFA index does show up very differently. So if you've got a lower socioeconomic area, all things equal, generally those that have had the CIFA index 8, 9 or 10 have been the ones that have had the steeper reaction in terms of a tight market, bigger price increase. Whereas you've got some of these areas that are lower socioeconomic, doesn't matter how much the vacancy rates reduce, prices have only been marginal in their rise, because people can't afford to give you an extra $200 a week.
Yep.
Now, for those people though, an extra $20 or $30 a week, that's a lot of money.
Yeah.
So it's interesting to see the market dynamics and how much I've learned in the last 2 months just observing, because everywhere is just almost that in one fell swoop we've had a similar impact in terms of vacancy rates trending down and low, inventory trending down and low, and now we've got a method to kind of categorise and understand the dynamics of each market and classify them. So and you can pull them out and say, look, the markets that are higher advantage markets behave very, very differently.
Yeah,
it's interesting because, of course, when you're sort of measuring things by looking at rental values, the rent, right? That's a lot slower marker than sale prices, right? Sale prices, you've got one property, it goes on the market, people fight over it. If the price goes up and it relative to other properties, then you start to see prices move, right? Whereas rental, people sign up for a 6 or 12 month lease, and therefore there's a delayed impact of, on increased rents. You know what I mean? Because, if rents are rising in an area and you might have a bunch of people sitting there on paying old rents, and it's not until their lease comes up for renewal that actually starts rising. So what would you see would be the delay in, I guess, seeing an impact or seeing when prices are on the rise?
I'd say the theory that I hold out is landlord pride, in that they want the same rent as they had last year. Yeah. So that is the biggest factor in my view. That's a theory I have, is that they hold on to the last rental, placing immense pressure on the property manager as the poor meat in the sandwich, and they don't react or understand the market dynamics enough to say, hey, I'm going to cut you some slack, chop $20 off it.
So that's when it's falling. But what about when it's rising?
Well, when it's rising, I think that it's interesting here. The rising market gives me. I've got a whole new theory there, and what we've seen is a lot of the regional markets were the lowest in terms of reaction, especially in the sale price side of it, because they didn't have I don't know what it was, but you'd think, wow, they could have listed that property for much more. So though it wasn't underquoting deliberately, it was just conservative regional real estate agents using comps and they're not adjusting the comps for market movement, and they were underquoting it, and hand over heart believed that was the right sale price. So I've seen it up here in Newcastle where properties were listing and they probably should have listed it for 200 or 300K more.
Yeah.
And there was no malice. There was no malice at all.
Yeah.
I've seen this happen too, that if it's not on an auction area, so you're not sort of used to that whole idea of, underquoting. But also indexing. I mean, we've had to be really, really focused on our indexing when we do our price research in the business, because, when you've got some months like last year, I think was it March? I think it was the biggest month. You've got some months that prices going up 3% and 4%. Like, that's crazy and unsustainable. But if you don't factor that in, you are going to always be out. Whereas I've never met one sales agent that indexes.
Yeah. Well, I think it needs to be done here, even in the valuation sector, whereas the appraisers in the United States use something called a grid adjustment system. So they will index it by market indices, but they'll also do size adjustment. So if you bring in a comp that's one extra bedroom or a comp that's one less bedroom, you make an adjustment based on a coefficient value or a dollar value. And that's the way AVMs work. So if you take the best of that, but you put it in the hands of a human who has the ability to judge quality, you've got the best of both worlds. So I think we've got a lot to learn from America. Yeah,
it's funny. We had a client this week using a buyer's agent, pretty keen on a property. Buyer's agent said to the agent, look, I think it's worth, mid ones. And the agent goes, I agree with you. He goes, this will go probably closer to 2. He goes, I actually think it's probably only worth that. But based on what I'm seeing, this is what it's going to go at. And it was in Brisbane, but it was quite a hilarious conversation because the agent's like scratching their head, just going, this is just, I don't think it's worth this, but this is what the market's going to tell me. Like, this is the feedback I'm getting and we're talking 20% above what they both agreed was a fair price based on all the comparables. And he's like, he said, I'm happy to pay this today. This is what I think it's worth. He goes, well, I know, I agree with you, but I'm pretty sure I'm going to sell it for this. And I think that's
they're bound by the comps. They can't make that adjustment. The comp price was the comp price.
Yeah.
And if those comps are now 20% higher in price, that should be reflected independently. Objectively should be reflected in the CMA.
It's and in Brisbane too, you've got a lot of Southerners buying up there and taking with them their Southern mentality in terms of what's value. Yeah. When you compare like for like in Brisbane, Sydney or Melbourne, Brisbane is cheap, and this is a big problem. We've seen it just locally here when people come from, even just in Sydney is a classic. The eastern suburbs versus the inner west. You do get more for your money in the inner west, and it's a big agent sales pitch. Oh, we'll get to the eastern suburbs buyers because they're really stupid. They don't realise that. They don't need to pay that much, but they will. And in some cases it does happen, but I think definitely in one city it's not quite, it doesn't really happen that much, but certainly from city to city, I think there is that sense of, oh my God, if that was in Sydney, it'd be worth X, so I'm happy to pay W,
I think it happens in Sydney. I think, people especially where I'm in the beaches, they come from the east and, we've and multiple clients over the last couple of years where people have, well, if I was buying this in the east, it would be, double that price. And then it's like, well, it's not in the east and it's on a main road and it's not a great property and you're paying this price for it. Okay, it's, but that mentality does matter because people go, well, I'm comparing in their mind like for like beach close to the city, and for that's good comparable value. And that's what's so, when I looked at Brisbane at the moment, you think, client bought a couple of places in the last couple of weeks. And I'm like, for 2.5, you bought that? Like, that's a lot of property. And in Sydney, you don't even get a 3-bed terrace, right? So yeah, it's crazy when you do come from a city and you move to a new city because it's so hard to let go of all those, those beliefs or those negative experiences you've had missing out or not being able to get a dream home.
Well, Brisbane's interesting. The inner ring, the gap is going to close without a doubt. The market's so tight that I believe that the price gap between the southern capital cities and Brisbane will change for that inner ring. But what's really interesting with people going up to Brisbane is, the locals don't really like anything outside of 15K, whereas the people coming up from the southern states look at it and say, wow, this is amazing value 20K out. So the gap really broadens out commensurate with the kilometre distance.
Yep.
It's a funny one though too because there's that thing about the locals wouldn't buy it. They wouldn't pay a premium for it because they know how difficult it is to get around. But if you come from Sydney and you've been sitting in traffic for I drove my daughter to school the other day. Normally it would take 15 minutes in a normal run for me to get. It took me 15 minutes to get her to school. Took me 55 minutes to get home. It's just a joke. Anyway, so
won't be doing that again for a while.
No, except that the train's on strike and all the rest of it. But anyway,
just a little side note. I've been plotting all the infrastructure projects on my map, and what jumped at me was the amount of rail infrastructure going into the outer suburbs of Melbourne, and also linking the regional cities. So they're not fast trains, but they're reliable, faster trains. and expansion of services. So those who live in the outer burbs or the commutable distance regional cities of Melbourne look like they're being well looked after.
Well, there is this fast train to Geelong. I'm not exactly sure where it's up to in the process, but that seems pretty likely now from what I've read over the last year or so.
And then when you look at and compare and contrast what's happening in the other states, you go, well, Chairman Dan's got one thing going for him.
Now, units. We did sort of touch on units, but that's obviously quite a different scenario. We were talking a couple of weeks ago and you were suggesting that units supply is actually coming down a little bit.
It is. So, with the exception of Melbourne Inner, so Melbourne Inner just doesn't, the dial's not really moving yet on Melbourne Inner. So we will have to wait until the borders open up to see if things change in Melbourne Inner for inventory. It just keeps on, you think, we're on a roll here from 14 months inventory down to 12, and then it goes back up again. So there's so much pipeline supply down there that we can't get on top of it. Whereas if we look at all the other cities, there's only a couple of pockets that I'm worried about in Sydney, was around that Parramatta area with a bit of pipeline supply and higher inventory. But by and large, most of the apartment markets, because of affordability, are improving. So I think the biggest driver here in Sydney, for example, less than 5% of the suburbs in Sydney are going to offer you a property for under $750,000 as a median house price. So you really are, if you're a first-home buyer in Sydney now, what are you going to look at?
We've had some people come on the podcast before that have been very excited about buy units anywhere, and we were very much saying, no, that's not a good idea. And there's evidence of places in Sydney that prices of units have gone down over the last 12, 18 months.
It's the 10 year.
Parramatta for one, you've got places like, Colgara and, Wooleye Creek and, Rosebery and etc. There's lots of these high density gluts. You've seen a Sydney property boom, but these areas have gone backwards, and there's still heaps of apartments. And so times are getting better, but they've had a pretty tough time. They've had none of the rewards over the last 2 or 3 years with super low interest rates. And that'll run out of steam pretty quick, I think, because, higher interest rates will be scaring a lot of people to take less risk rather than FOMO just forces people to take ridiculous risk. And people are getting more educated. I just feel that, this story is getting out more and more, the importance of buying a quality asset.
Well, I'd like to think it is, but it's funny. I actually had a strategy session with some people yesterday, and they're looking at, obviously they've got a small child, they're wanting to buy a family home, they're looking at sort of what their options are. They already own an apartment that they've owned for 10 years in that sort of Homebush area.
Yep. Mm-hmm.
And so they wanted to hold it as an investment. So I was quizzing them as to, what is it about the property that makes you want to hold on to it? And there's, various reasons that they had. And I said, well, we talked about, opportunity cost and et cetera, et cetera. And I said, okay, let's just do an exercise. I literally did it live. I went, right, get on to realestate.com.au. Let's see how many 2-bedroom apartments are currently on the market in Homebush. And there were 99. Some new stock coming on as well. So there's this new supply as well as competing with existing. And I'm like, I'm just going to randomly pluck another suburb out. Literally don't know what I'm going to find. Let's look at Leichhardt. It's within that 10K radius of the CBD. I'm not saying, you should buy in Leichhardt, a 2-bedroom apartment in Leichhardt, but I just want to see how many are there. And 10. Yeah. So it's like that's in one city. So back to your what you said earlier, Kent, about, there's no such thing as a Sydney property market or whatever. We're actually talking sort of inner west, regionally somewhat the same there, but massive difference in inventory levels. And,
it's a really good point, Veronica. So that client, I literally last night got an email from a client, and many years ago, probably 4 or 5 years ago, they came to me with an apartment in Homebush, and I was very much like, this is not ever going to be a good asset. You may be able to sell it 5-10% more if you get the perfect situation, but you're going to potentially buy a cheaper house to keep hold of this place, and they did. And fast forward, they're coming back to me last night and saying, look, we're thinking about selling the Homebush apartment, and I literally just brought it up on CoreLogic, and it's basically been hovering 600 to 700, and it's around 650 now. So it's like the exchange rate just showing flatlining. And it's been like that since 2015, since the height of the investor boom. And so what they've done is they've gone a bit conservative on their house by trying to keep hold of this investment because, it's that pain of, I'll be able to sell it in the future, right? They're A, not going to get a better result. They're finally taking, and B, they've lost out because they were more conservative on the house. And if they just went a bit for a bigger house, let's say, it'd be a much better situation. And so if you've got a dud asset and it's holding you back from other decisions, factor in the opportunity cost because that's the painful cost. They're not losing any more money on this place, but they have lost what they could have done 4 years ago and where their situation would be.
Well, looking at the SA3 10-year median change of the two asset classes of houses versus units across the country, it's half. Now, and when you factor that in, it's half the growth rate. That includes the median being mashed up with new stock.
Yeah. So
it's not like the US analysis where we split out secondary and new. It would amplify that gap even further.
I know. I find that sort of so frustrating with apartment data that it's sort of because there's some good results mixed in, but there's only a small percentage that actually gets a good result. So the good results, are just missed, but that bad results overwhelmingly drag everything down. And I just think that even just looking at that aggregate amount, 50% less than houses, it should be enough to warn people off jumping in and thinking that they're going to be able to use that as a stepping stone strategy to their next property. That's the danger.
Going back to your situation, sorry, cut you off. You want to finish something?
No, I was about to say with Kent, because I know, Kent, you've been talking about, and I've sort of stolen some of your your ideas. Stolen, generously being bestowed, I don't know how you want to call it, but you've spoken about the decoupling of value, say along the coast. You sort of got the highway, and you got the properties on the coast side, and then you've got the properties on the other side of the coast. Yep. That decoupling, you've been talking about decoupling of outer suburban properties versus inner urban properties, and that gap that's widening and widens so great that really it's really difficult to leapfrog from one to another. And I guess the apartment market is probably the best illustration of this phenomena.
Yeah, my concern is more the social impact that because you don't have a wealthy family, you're now forced into a substandard asset class, and you're now bound to a lower level of wealth in perpetuity. Now, a great example is if you divide up the market into quintiles and you say the top 10%, the top 20% of Sydney versus the bottom 20%, the growth rates over the last 12 months, 24 months have typically been a 5 or 6 times variance, the gap. So that means that if we just took housing price appreciation as the indicator of the wealth gap, it's grown by 5 or 6 times in the last 2 years. Yeah, it's huge. It's huge. Yeah. Now that's the housing market. Imagine that. Amplify that when you get to a substandard asset class of apartments versus houses. Yep. And this is what we're forcing a lot of young people into. So you'd have to say to them, think twice and think about a housing market rent vesting opportunity, especially with build to rent coming in. Saying, I'd rather a really nice build to rent apartment and go and buy a house in a solid area that's affordable for you.
Yeah, we have those conversations with clients. It's not going to. If you really just need to want to live in an apartment and it's all you can afford, then don't go buy it. Let's just invest your money and buy one crop. It's really important for that first, place for someone because if they take a wrong step, then they're not really getting ahead. They're just potentially missing the opportunity of time and and if anything, taking a lot of risk for no reward. I think the thing that I just want to point out on your data, Kent, you said that Rouse Hill, Sydney. Sort of Balcombe Hills has got potentially up to 2 years of inventory sales volume. Yeah, it
ebbs and flows, and you get a whole new release, a whole new section of properties released in these house and land areas, and there is always that lag with it being captured in the sales volume. Okay. So that's always the limitation with house and land areas. But what was happening was it kind of went from red to yellow to getting close to the shade of green in terms of market risk. The stock levels were being absorbed in Rouse Hill. So it looks like it's spiked again. And what I'd say is the best way to read that data is it's vulnerable, because if demand drops off,
right,
it's going to be one of the areas hit the hardest in terms of excess inventory that needs to be cleared. Now, in the case of, some developers can just hold the stock. And in the case where it's a virtual house and land package where it's just land, the holding costs are low. So that's probably a couple of call-outs there. But there are some markets that are traditional secondary markets that are on that list that are some call-outs there. So I think that's interesting. But that's on the negative side, but there's some positive ones. And I think there's some really robust markets.
And let's hit that in a sec. But I just want to point out, remember back to our very first Suburb Trends episode, and we started by going, through the bottom fives and the top fives and whatever. And Rouse Hill just kept making
Always
the list
there.
every month, and we just stopped having that format because of it. And so I guess it does no surprise that it's a vulnerable market. It's always been a vulnerable market, and the market itself may have disguised or covered up that vulnerability for a period of time, but now it's it stands out immediately because of that.
Yeah, and I'll go back to it. It's a lot of the Perth areas where you've got this strong pipeline. There's vulnerability purely on the inventory analysis, but then there's vulnerability for the first few years in that, if you look at mortgage insurance claims, etc., a lot of them, the vulnerability period is the first couple of years.
Yeah,
so when you've got a whole new estate with people who are brand new with their mortgages and settling in with new debts and whatever, these are vulnerable communities.
Don't get divorced, don't lose your job. That's
Correct.
basically the message.
And back off on the subscriptions. Don't spend all your money on subscriptions.
I just
Robust
did notice
markets.
Netflix up their subscription this week. $5 a month. That's a pretty big jump.
Isn't that a 50% increase?
I think it was maybe 20, which I was like, whoa,
Cheeky.
hello. That's all right. I'm not going to say no to that. Quick button, and off I go again.
Okay, robust markets.
Robust. I've got a list of a few here. Belconnen, it's just been up on top of the charts. So even with my assumption that sales volumes could fall, it's still tight, still tough. Hornsby is there. Sutherland,
Housing markets you're talking, yeah?
Only housing markets by SA3.
You think about this, next one you're going to say is Sutherland. Sorry to cut you off.
Yeah.
They're the two pockets that first home buyers in Sydney, that are earning, pretty decent high incomes, right, can only really enter because they're sort of sub 2 mil-ish, and that's where a lot of first home buyers will run out of steam. I mean, obviously there's a lot of first home buyers running out of steam at 1.5 and 1, etc. But, that double income, 300,000 sort of income, they deposit and income will start capping out there, and plus confidence and, worried about debt, etc. That's the only pockets they can really go to from, if they're thinking about going, leaving the inner ring, they kind of want to go north, around the national parks and, potentially go up the Central Coast, or they want to go down to Sutherland. And so they're really hot markets for our clients who have got budgets sub 2 million.
What's in common
sorry.
is the train line. Both of them are on the train line
Good
as well.
train lines, and there's an
That's
upgrade to Heathcote Road and a bit of infrastructure going in there.
That's true.
Sutherland jumped out on the maps for me using the ratio of household income to house price a couple of years ago. So for that exact same reason, Chris. So 2 years ago, it was off the charts in terms of, this in terms of what people can afford versus what the house prices are based on local income rates, levels at a household level. It was a cracker. And that, when you add that to all the other variables such as low inventory, it was a standout investment area, owner-occupied area.
You're saying the incomes were high to the value of the property?
The ratio of income, so typically if you kind of say more than 30% of your, this is the demographia standard where they say more than 30% of your household income's being spent.
Yeah.
By any measure of housing affordability, because their incomes were higher relative to the house price,
yes,
it jumped off the charts for me a couple of years ago.
As a good opportunity where, that people are not stretching to buy into the housing market there because they're on great incomes and their houses are reasonably cheap. That's also shifting because a lot of people who traditionally aren't from the Shire I know that's your neck of the woods, Veronica. I probably shouldn't tell people that, I think.
I've confessed a number of times I did leave a long time ago.
But a lot of people have come from, not from Australia. Sydney's got a very multicultural country. People have moved here over the last decade, right? We get clients of... and they just
even
love
the
it.
Shire's becoming multicultural.
Exactly.
Never.
Yeah, there was beach rights, not that long ago. But you're right. But it's definitely, especially people from Europe and English in particular, they love it down there. And the thoughts of moving down there, they're like, yeah, no worries. Yeah, I'm happy to go down there. There's a train, easy to get to the city, beautiful water, I've got National Park and South Coast, and there's no connotations of what it used to be. So. I think, and they're going there on high incomes. They're city workers because the train line is so easy for them to get to the city. I think it's a great spot down there to own property.
Brisbane Inner East is the other one, really robust. The whole inner Brisbane now, it is solid.
We're talking houses.
Yeah, houses.
Just to be clear.
I've got Tullamarine Broadmeadows.
Ooh.
So that's looking solid. I've got Warringah, which is kind of always your go-to. Just in terms of its inventory level, even with some reduction in demand, it's still remaining super tight.
So that's that lifestyle market.
Sorry? Lifestyle
market, yeah.
The last one on the list, Marrickville, Sydenham, Petersham.
Mm-hmm. I mean, when you say Warringah there, that's sort of up my hood, right? So the Northern Beaches sort of pocket, right? That's what you're talking about, yeah?
Oh, look at pretty much everything all the way through the peninsula.
Yeah.
We haven't mentioned Newcastle. I just realised, but go on.
We haven't. We've left Newcastle out. Look, the inventory levels have slightly risen for Newcastle, but it's strong, and there's a lot of announcements coming out about
trains,
new alternative power. There's a lot of infrastructure projects on green energy, etc. So I think the jobs market is going to be the first thing. I don't know about the train. Everyone up here is so cynical about any mention of a fast train because every election it gets wheeled out.
Well, I think they've run out of cash, haven't they? I think they might even can the Beaches Link tunnel, which I was hoping for. But what I was mentioning there on the beaches, yes, stock is tight, but talking to both agents who are friends with up locally and buyers agents is that, and this is happening all over Sydney, is the quality stuff is absolutely still getting lots of competition. And, without doubt, it's still selling fast and still good prices and higher than last year. But the other stuff is starting to really flatline, and if not, go down a little bit. If it's compromised, people are really hesitant to take on that big mortgage. And so it's much easier buying. It's low listings, but it's easier to buy. And we've had, clients who, due to budget, buying in these, not the top stuff. They're able to get contracts signed. So I do think things are changing a little bit for the things that are a little bit compromised. A lot of money, but, do you want to make that compromise?
Well, I think we're returning back to normal. I wouldn't be surprised in 4 weeks' time we don't do another analysis and say the average SA3 is going to be closer to 5 or 6 months of inventory.
Yep.
And and that is a market that's pretty balanced.
Oh, I love a prediction.
We'll put you in the report.
Brave man.
We're doing a new forecast report at the moment, just focusing on the banks, and
yes.
We could just throw Kent in there.
Depends on what day you ask them, doesn't it? It does vary week to week.
That's what our report's already starting to show us. But anyway, we'll leave the insights till April 1st.
Exactly right. We'll be bringing that out for you. Yeah, it's an interesting one. All right. So I guess anything... Oh, anomaly. Almost forgot the anomaly.
Yes.
You got one for us.
I think the anomaly really is that we don't see the price data. What we're seeing now in terms of an increase in inventory levels, we don't see that reflected in the prices until there's a decent lag. So it could be typically 3 or 4 months' time before we see it flow onto prices. A couple of reasons for that. Obviously settlements, but it takes time to sell a property. It takes time for the sales data to get processed. But equally, it takes time for it to be captured in any analysis that uses a rolling 12-month median.
You can figure it out pretty quick, though. You can get in the market yourself. And
you can squeeze up your sample size, and you can go from. You can do it a few ways. One is you can do the rolling 3-month median at an SA3, which is quite okay. So that's one way to do it. That does still have volatility. Your trade-off is volatility. But your other thing you can do is you can pull up an individual property and then do a price analysis or a CMA as at a year ago and say, how much did this property sell for and how much would it have been worth a year ago? And you do that, by the time you get to the third or the fourth property, you got a pretty good handle on things.
Yeah. Or even just get into what I sold at the auction last weekend and start to really, and get out and get on the ground. I think that's always the best option to figure it out. Even if you don't know looking to sell or whatever, or transact in the market, just go to a few open homes and, get a feel of what people are doing right now.
Absolutely. Get on the ground. Right, well, that's been very interesting, and I guess watch this space. I mean, we know that the conditions of 2021 could not continue forever. It's inevitable that they would slow down at some point and levity return to the market. And also the normal, you can't have everything going up, that you sort of have to... the market needs to go back to its normal behaviour, and that there are some places that have continued demand and some types of properties that will have continued demand. There's others that don't, that really people only go to when they are priced out of their better stuff, I guess.
Awesome.
All right.
Good chat, guys, and hope everyone's enjoying the episodes.
If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au.
Thanks for joining us. We'd love to see you again.
And remember, don't be a Dumbo.